Okay, let's talk about some tax. Tax is a big thing here at Blue Sky, and uh, not only for individual investors, for business. So we're not going to try to turn you into business tax preparers here if that's not what your firm does. That's fine, but there are some key things as their advisor that you need to understand how it works. So first of all, some of the basics here, looking for things. Where does the income come in from a business owner? Obviously, line one, their wages. Schedule C, if they're sole proprietor. Schedule F, farmers. Schedule E is where your partnerships and S Corp comes in. Here's one, line 3A and B, where your dividends come in. So a C corporation, as you know, pays its own tax, but the business owner can take out dividends, and so they get a 1099 div, just like if it was from Coca-Cola or something. So keep that in mind. Schedule 1, line 14, 15, and 16, that is your self-employment tax here, the self-employed retirement plans, and then the self-employed health insurance deduction there on the new Schedule 1, line 14, 15, and 16. Here's your 1040. Everybody's seen that. You know where the lines are. Line 1 coming in there for the wages. And of course here, line 10, the qualified business income deduction. Those are all clues of where some of the more prominent business income items show up on the 1040. So you definitely want to make sure you know where to get those from and how to interpret those numbers. Okay, let's talk about the Schedules K1. A lot of your business owners are going to be S Corps or partnerships, and they issue a Schedule K1. They're slightly different. They're both called Schedule K1, but one from the S Corp, from the 1120S, it's a little bit different than the one from the partnership 1065. But suffice to say, they break out the income into a couple of places. Ordinary income, any rental income that the company receives, the deductions, what are called separately stated items, so things like charitable contributions, dividends, interest, those type of things get passed through on that K1 to the 1040. And then of course, distributions. Box 16 on the S Corp K1. This is a number you don't want to miss. This is the money that they're taking out of the company that is not wages, not benefits, not tax-free benefits or perks, things like that. So you want to make sure you know where to find that on the K1, because that can be significantly larger number than the W2 line. Also on the 1065, at least, I didn't put it on the slide here, but box 14 talks about self-employment income. So a partner in a partnership who is considered a general partner or manager is going to have self-employment income flowing through on box 14. And that's really important that you understand how a business owner, how their income is classified as self-employment income or not self-employment income. It can make a huge difference in their tax. So here is an 1120S K1 for you, just so you can see there. 16D, shareholder distributions. 17V, this is a critical place. This is where all the information for Section 199 comes in. If you're not preparing the tax, it may not mean a lot to you, but if you're interested, that is where all the information comes from the company, so that the individual taxpayer can compute their 199 deduction. As I already said, it comes in on line 10, Form 1040. You've probably all been 1099 to death, but it is an entire briefing on its own, but it is so important. I can't tell you, maybe it'll get a little bit better this year, but for those clients that we prepare taxes in-house, but for those that we don't, I can't tell you the number of 2018 returns that came through that either it was missed, not calculated correctly, or they lost a huge opportunity to optimize it. We have a client that makes $6-7 million a year from their company, but pays very low wages. And as you probably know, at the higher levels of Section 199 income, you have to pay 50%. It's based on 50% of the wages is the limit. And so just by tweaking their salary, we were to save them several $100,000 on their taxes. So understanding how that 199 works, if they have a preparer, you'll know best how to handle that situation. But suffice to say, a lot of it is not being handled correctly, and we can play a valuable role in making sure that they get the maximum deduction from that. Okay, business income tax. Like I said, if you don't do taxes, don't want to turn you into a business tax preparer, but you have to learn how to read at least the minimum of the K-1. During that data gathering, I like to see you get the whole return. If you can't get the whole return, at least get the K-1 and understand what you're looking at. If you do get the whole business tax return, balance sheet is the most important thing on there. Understand what you're reading, understand what debt is owed, understand the assets of the company, at least the book value. The balance sheet will also have things like shareholders' equity and some other different things. So familiarize yourself with that. The second thing I want you to do is take a look at that business tax return and kind of have an understanding of how the company, what I call, translates a dollar of revenue into EBOC. So EBOC is the term that I like to use, earnings before owner compensation. So it's get everybody else paid, get the rent paid, get everything done before the owner takes any benefits, any salary, any distribution, anything. What is that number? And then that's where the real tax planning for a business comes in, is how do you divide that number up? How do you sparse that out? And so as a financial planner, you want to understand how the company does that and what is that EBOC that is available to your client, the business owner, because that's the real number that you need to understand for cash flow, for what they're spending. And if the business was to fall on hard times or they want to get out, that's the number that you need to replace, is the EBOC. Okay, this is one of my favorite slides. We're going to spend a few minutes on this. This is something that I came up with. When you have a business owner, unlike an employee, an employee shows up to work and here's what you get paid, and certainly they can go lobby for a pay raise, but I don't think many employees are going to ask for less money. With a business owner, like, they can set their salary within reason, pretty much whatever they want. And so there are different reasons that you would pay yourself a different amount. And so I've listed some of the ones here that you'll want to consider when working with a business owner and how to determine what to pay themselves. And I'm telling you, this is great stuff. Most business owners don't do this. Most CPAs don't do this at all. So strategy number one, minimize payroll tax. This is the most common one I see. Obviously, you'd pay yourself no salary if you could. Now that you can't do that because of number 4, IRS reasonable compensation, at least for an S Corp. Of course, if you're a partner in a partnership, an active partner, all of your income is subject to payroll tax. But theoretically, to minimize payroll tax, you want that salary as low as possible. Same thing if you have a big company and you're trying to maximize the qualified business income deduction, you would want to pay yourself as low a salary as possible. The case I just mentioned with a company that was making all the money, they were not maximizing their QBI because they weren't paying enough in salary. There is a formula, so the optimal number, it works out, if you do all the math, is about 27.9% of the net income of the company should be paid out in wages to maximize the QBI deduction. It's really a fascinating calculation if you have nothing else to do to replicate that. Of course, the IRS has a minimum fair market value salary for an S Corp. It's one of their areas of focus. If you're trying to maximize Social Security, of course, there's no incentive to go above the wage base, which for 2020 is $137,700. A spousal 401k is one of my favorite strategies. Once again, if you're under 50, pay them $21,115, subtract out their portion of the Social Security, Medicare, and it leaves you $19.5 to put in a 401k. Likewise, that are above 50, that number is about $28,000. There's no reason to, unless you're trying to follow one of the other strategies, which is like maximize Social Security benefits, these are the numbers that optimize that particular salary. Once again, if they have a new comparability 401k with profit sharing, there's no point in paying over $150,000 salary unless one of the other exceptions applies, because they can't get anything more than 57,000, which is the deferral plus the profit sharing match. Same thing if they have a cash balance or defined benefit. No point in paying them over 285,000. They're maxed out at that amount. Some of the other considerations, when we do the strategy planning, the salary, we come up with this great plan and we say, okay, business owner, you need to pay this in salary and put this in your cash balance plan and put this and do this and do this. And they're like, well, I need 500,000 to live on. Or, hey, our business doesn't have that much money. So that's one of the things keep in mind is you have to take into account what they need to live. We already talked about the owner-occupied building and the fringe benefits, but once again, they have complete control over their salary to some extent, and so you want to make sure you have a strategy for what you're paying them, or what they're paying themselves, excuse me, and not just a random number. Okay. Some simple tax reduction strategy concepts. Number one, structure beats deductions. Some business owner in December calling you up saying, hey, I need some deductions. What are some things I can do? Like, they've completely missed the boat. You got to structure your business, structure your life, beats deductions. Utilize multiple entities. We already talked about that. Pre-tax, your lifestyle, do things on a pre-tax basis. Shift income to children, shift income to different lower, a C Corp taxed at 21%. Don't be afraid to shift income. Now, it has to have a purpose. The IRS, step transaction doctrine and some other things. I mean, there has to be a business purpose for it, but you can come up with a business purpose pretty readily. The sole purpose of that cannot be to avoid income tax. Same thing, change the character of income. Change wage income to distribution, change wage to rental income, change the character to a lower rate of tax. Effective tax rates for business owners under the new tax reform in the mid 20% are absolutely possible. I don't care, people making millions of dollars utilizing multiple entities in some of these strategies, you can get that number into the mid 20s. Section 1202 company is a special kind of C corporation that you can actually take the money out of the C Corp tax-free after 5 years. It's a really complicated area of the code, but if they have a CPA, have them ask about it. It's a great opportunity. Charity, this is one of my other favorite ones. Myself and a lot of my clients are very charitably inclined. Way better to give through the business's advertising or sponsor something. This weekend I went to the Heart Ball, the American Heart Association. Way better for Blue Sky to sponsor that Heart Ball than to me to write a check. Calculated about $2.17 of wages is required to make $1 contribution, as opposed to just give them $1 from the company, sponsor something. There are some limits on that and a special limit for C Corp.